What's up, everyone? It's Caddy with Money Investing. In this video, I wanted to talk a little bit about the personal consumption expenditure, the PCE numbers that came out today, which obviously resulted in the markets selling off quite a bit. I'm going to explain to you the difference between the PCE and the CPI because I still see a lot of confusion and people don't really understand what's the main difference and why the Fed basically prefers personal consumption expenditure over CPI. So we're going to go over that difference first, and then I'll talk about the numbers that were released, and we'll dive into some of the data. We'll do some analysis for ourselves, the 3-month, 6-month, 12-month annualized numbers, and why all of a sudden after today it got a little bit more real, a little bit more concerning for the markets, and why interest rates also did flip a little bit moving forward. So hope you guys enjoyed this video, find it helpful. If you do, don't forget to subscribe to the channel, and also make sure that you hit that like button. And the Discord and Patreon is going to be down below if you're interested in joining us, getting access to all the alerts, options alerts, trade ideas, all the private videos and channels in the Discord. So there is going to be a 16% discount that is available till the end of this month. So first, let's just talk a little bit about the difference between PCE and CPI. So the most important difference that you need to know between CPI and PCE is the way that they are calculated and the data that's included in these two reports. CPI is the Consumer Price Index. PCE is the Personal Consumption Expenditure. CPI is calculated and reported by BLS, which is the Bureau of Labor Statistics. PCE is calculated and reported by the BEA, that's the Bureau of Economic Research, right? BEA is going to be Bureau of Economic Analysis. So they're the ones that actually do calculate and release the PCE. Now, in terms of the weightings, CPI is fixed and equal weightings. In other words, not equal, but I should rephrase it. They are using a fixed weighting of the basket of goods and services that are included in the CPI. And PCE uses what's called a chain-weighted approach, which means that the basket of goods and services and their weights are updated every year based on the most recent spending patterns and trends. So weighting, there is a difference. Who calculates and who reports it, there's a difference. And the most important difference is the fact that CPI is only for urban consumers, but PCE takes into account both urban and rural consumers, right? So PCE covers the price of all goods and services purchased by all households in the economy, including both urban and rural consumers. CPI only covers the prices of goods and services purchased by urban consumers. So it gives you a little bit more of a holistic approach, gives you more of an aggregate data when you're looking at PCE. That's why the Federal Reserve prefers PCE over CPI, because CPI, the weightings are a little bit different. They're only for urban consumers for fixed weightings of goods and services, and PCE takes a chain-weighted approach, a little bit more current, a little bit more up to date, and of course takes into account all the households in the economy between rural and urban. Now, going over to the actual numbers for today. So the numbers were not super great. We definitely came in very, very hot in terms of the month-over-month changes, and year-over-year, we're now pushing up a little bit, which was what the concerning part was. So if I pretty much mark those things here very quickly, what you'll notice is a 0.6% gain in personal income. And then this right here is what we're really focusing on, 0.6% gain for both PCE and excluding food and energy PCE. That's going to be your core. Let's zoom out a little bit more. So that was the number. Price indexes definitely coming in super hot month over month. This was also higher than what the consensus was. And not only that, we did get a year-over-year number, which was at 5.4% and 4.7% respectively for PCE and core PCE. And that was higher than what we had previous months. So we had a little bit of an uptick. In other words, we did flare up on inflation once back in, because if you take a look at here, 6.3, 6.1, 5.6, it was coming down, it was coming down, it was coming down, 5.3, it was coming down, and then now 5.4% is an uptick, right? So the Federal Reserve and Jerome Powell, multiple times quoted the word disinflation. In fact, I think they used that word 12 times in their last FOMC meeting. And this right here, the PCE number that we just got, is anything but disinflation in the economy. And this is more of a visual representation. So increasing by 0.6%. So we were trending lower. We in fact got some deflation back, last year in 2022, month 7. And then, of course, a big spike here, 0.6% coming in. So PCE core services, excluding housing, the Fed's most watched measure, currently moved higher in January, with 3-month annualized percentage change moving up to 5.2% and 6-month annualized percentage change moving up to 5.4%. And as a result, the interest rates are also getting pushed higher a little bit. So we're now expecting no cuts in the market. So literally the market's in sync with what the Federal Reserve has told us. Literally no cuts in 2023. And the probability for us to see over 5.5%, almost up to 6% is increasing day by day. We were at one point all the way up to 10% probability. Right now it's come down a little bit to 7.3, but definitely a pretty substantial number. Now, again, this right here is the uptick. So if you come over to investing.com, you can see that we were trending lower from 6.8 down to 5.3%, and now we're pushing up back up to 5.4%. This is suggesting a little bit of that stagflation type environment, which Ray Dalio's also been talking about. And this is going to be that month over month, which once again, you can see the big spike here, 0.6% is what we got. Pretty hot number. Now, I've kind of put together a list of PCE, core PCE, CPI, and core CPI on a month over month basis over the last 12 months. And what you'll notice is that the 12-month annualized right now, we're sitting at 5.3%, 4.4. For CPI, we're sitting at 6.1, and core, we're sitting at 5.3. So these are stagflation numbers. For 6-month, however, and 3 months, the numbers look a lot better because, look, the more recent data, there's no doubt about it. The more recent data, which is 3 months and 6 months, there is a lot of disinflation, right? There is a lot of expectations that inflation is trending lower and it's going to continue in that trend. It's going to continue to push lower. And that is still true because that's what we have seen over the last 3 months and 6 months. So you can see that annualized, these numbers are much better looking than compared to the last 1 month and the last 12 months. So PCE expected at 4%, 3 month, 6 month basis. And of course, core sitting at just under 5%, and CPI expected under 4%, and core sitting at a little bit under 4.4, 5.2%. Again, a lot of it has to do with shelter prices. Obviously, it's kind of keeping it higher a little bit. But this past month, you can see this was the highest print we've seen in a long time. And as a result, annualized this number now on a forward basis, suggesting, once again, well over 7% in PCE and core, and CPI 6 and 4.8% respectively. So this is the chart that we're looking at. This is the uptick that we just got for February print, which was for the month of January, right? So February CPI numbers, PPI numbers, and PCE, all three were not great for the markets. And as a result, for the month, I believe we are maybe slightly higher. For the month, we are down 2.6% for S&P, and the NASDAQ is also a little bit lower, 1.6%. And take a look at that candle, right? So a shooting star candle after a very strong 10% January, we are now starting to see sellers step in, and a little bit of a reality check for the markets, as we have already talked about. Now, all said and done, I think it really comes down to what shelter is going to do for the economy moving forward, housing prices, and that's really going to be affecting interest rates, the bond market, and which is going to be in turn affecting equity prices. As I've already mentioned before in my previous videos, I think we have to be cautious in this environment considering how high the valuations got, considering how high technicals got, and the fact that we were getting a counter trend rally on the bonds and the dollar index itself was a telltale sign that we need to be careful. I've done videos on this, but the 10-year yields, they were pushing higher. They're almost back up to 4%, right? So this past month, they're up 12%. So it just didn't really make sense for the markets to be pushing higher in that environment. So we're at 3.9.5%. This month, the 10-year yields are up 12%, which is pretty substantial. The dollar index this month is up over 3%. It's back up to over 105. And volatility this month is up a little bit over 11%. So once you kind of put these pieces together, we have to be careful. We have to be cautious. We can't expect the markets to keep pushing higher. And as a result, we're seeing the markets rotate back down. Now, do I think that we're going to hit our October lows once again? It's possible. I'm not going to lie to you. It is possible if inflation prints start to stagnate a little bit on the sideways, if you start to see inflation not trend lower. And it's kind of like one of those analogies that I used in my previous videos, right? It's like if you're trying to lose weight, right? So if you are, let's say that, maybe it's not the best analogy, but if you are trying to, let's say, lose your body fat percentage, it's much easier to go from 20% body fat to 10% body fat. It's actually much easier. The hard part, the real hard part, and the challenge is going from 10% down to 6%. So those 4 percentage points drop is far more difficult than going from 20% to 10%. And the reason is because at first, right, there's a lot of momentum and you're following the right diet, you're following the right workout routine and whatnot. But towards the last 4%, you need to take everything to a whole new level, right? Because it becomes more challenging, more difficult to shed that extra 4% body fat. And I think the same thing can be applied to inflation. It's much easier to go from 9% to 5%, right? Much easier to go from 9 to maybe 4% inflation, but it's far more difficult to go from 4 down to 1 or 4 down to 2, right? Those last couple percentage points are actually more difficult to achieve than the first 5 to 6 percentage points. So I think eventually the Federal Reserve will have to come into this consensus whether to keep raising rates. I do still think the Federal Reserve did make a mistake by not raising rates by 50 basis points back in February, this past month. And I think they're going to rectify that mistake by going 50 basis points in March because of the inflation reports that we're getting now. A lot of it also hinges on the fact that there's another inflation print coming out in March. I think March 14th is when that next CPI numbers come out. So they'll have a couple reports to kind of dissect and then move forward with their rate hikes. But I think 50 basis points could be appropriate if we don't get a solid report in March from CPI and if shelter prices don't start rolling over very soon. So I hope you guys enjoyed this video. Just wanted to kind of break that down for you. And we're still nothing's changed in my opinion. We have seen a good technical rally. We have seen a lot of short squeezes. We've seen some decent earnings, but inflation is still unresolved. There is still a high possibility for a stagflation, and that is something that I'm going to continue to voice, and I'm going to be objective. It doesn't matter what my personal biases are. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video. Take care.